financing for restoration enterprises. So today's session, titled Unlocking Capital in Practice for Restoration Startups, will be facilitated by Sai Kumar, who's the principal of investments at Navaka Social Business Fund. Sai brings over 14 years of experience across impact investing, private equity, and advisory, with deep expertise in supporting early and growth stage enterprises. At Navaka Social Business Fund, he leads the end-to-end investment life cycle and also works closely with startups to strengthen their business models, scale operations, and also prepare for future fundraising. His experience combines both investment transaction expertise and hands-on support to startups, making him uniquely positioned to guide today's conversation. And today also builds on the discussion from our first two capacity building sessions that were conducted by Dr. Amrita, where we explored how restoration enterprises can locate themselves in the broader ecosystem and identify and strengthen opportunities across the restoration value chain. So, as many of you continue refining these opportunities, today's session is intended to help you take the next important step, which is to understand how your models can be financed, scaled, and positioned for sustainable growth through the right mix of capital strategies. So, just to summarize, the main purpose of today's session is to help you build greater clarity on near term capital requirements, strengthen preparedness for fundraising, and also develop a more practical and strategic understanding of capital deployment for growth. So before we begin, just a few quick reminders. Where it is possible, please do keep your videos on because that would support engagement. And we would also request everyone to actively participate either through the chat box or through raised hands. We'll be keeping an eye out so you can use whichever option you find comfortable. And with that, I will hand it over to Sai to take the session forward.
Great. Thanks, Ananya, and welcome everybody. I will be sharing a presentation. Please let me know if you can see it well enough, or just give me a minute. Okay. Okay, let me know if you can see my presentation.
It's visible, sir.
Yeah, and it's clear or it's blurred again?
It's clear now.
Okay, great. So welcome everybody. Uh, I would be handling today's session on largely where you raise capital, how you raise capital, what should be your financing strategy going forward. And I think as the WRI team and the Will Grow team have classified already the cohort participants, we will try and use examples or specific requirements of each of the various categories, be it sustainable agri, circular economy, NTFP, or soil restoration. We'll try and use different examples in each of your life cycles of the enterprises, and try and see at what stage what kind of funding requirement is typically the most efficient for your respective organizations. That said, I'll try and cover this entire piece in about 1.5 hours. I will give time for questions and answers. I would like, if it's okay, that we keep question and answers to the end. I also would request the Will Grow and WRI teams that I would not have access to the chat. So in case there are pressing questions that come in between, then please let me know. I'll try and answer that. Okay, with that, getting to the very fundamentals of capital. What do we mean by capital? Ultimately, capital is a resource that we use just like, so if most of you studied economics, you would understand that there are four resources, which is land, labor, capital, and I think market. If I've forgotten the fourth one or I've jumbled the fourth one, I'm sorry. So it's ultimately a resource that basically helps you move the organization forward. Now, labor is something that all of you already know about. Land is something that probably you have either owned or are leasing. All of that is there. Capital is where today's session will delve deep into. In this, we typically have three categories, or rather two categories usually for commercial enterprises. One, what we call equity, and the second, which we call debt. Now, of course, as a part of these two, we'll have a lot of subdivisions or types, and we'll come to most of those as we speak. Specifically for social enterprises such as yourselves, uh, we have two additional categories. One which is grants, and two which is a blend. Now, when we say blended finance, it could be a blend of the other three sources of capital that we see on the slide. So in any form or in any way, when blending of those capitals happen at a specific point of time or during a specific transaction, we basically term that as blended finance. So the first one being grant. Grant is basically, today you have both returnable grant as well as non-returnable grant. Typically, it has been non-returnable grant which has seen the light of the day. More recently, you have providers of returnable grant. More details of that we can answer later, but largely it's any kind of donation, any kind of one time, or you know uh, uh, might not be a repetitive way of getting capital. These are typically smaller in size compared to other sources of capital. These typically could be prize money, CSRs, probably grants from incubators or accelerator programs such as Will Grow and WRI. So these are basically non-dilutive in nature, which means that they do not take away any kind of ownership, or they do not take any possession in the company that they are given to. Uh, they could be given for specific use cases. So somebody could say that you are receiving a grant specifically to expand to a new market, or to test or pilot a specific a specific prototype, or they could be unrestrictive grants are slightly more rare to come by. Restrictive grants are of course what you typically see. This could be from sources such as TBIs, accelerator programs, all of those, which typically are for specific R&D or for some kind of pilots that the organization could be undertaking. Right now, a very useful thing that you could look at, and especially at the early stages of the company's growth, is that you could use grants to validate your product, validate your um, um, validate your traction. It could be validate your prototype. For any of all of those, especially for tech or technology based systems or services, you could use grants to prototype, develop, do R&D, and then launch the product, and at that point of time raise actual commercial capital. Right. So that's largely how we deal with grants. A very good source of grants that we typically do not focus on is government schemes, whether it is the startup missions or even before that. A lot of government schemes specifically for the startup ecosystem. This could also include because we are talking about, I mean, some of the cohort companies are focused on agri. This could also include schemes that are there by government organizations such as NABARD and their sister concerns. Right. So this is basically largely the grant uh, ecosystem. We move to the next source of capital, which is equity. This is totally on the other side, which is they dilute ownership. So if when you start your business, you own 100% of the business. The minute you bring in an equity investor, there is some bit of dilution. It the If the investor puts money into the company, it's basically called a primary infusion or primary investment, because that money is going into the business. Right. If they are buying stake from you or from any other existing investor, then it is called a secondary transaction, which means that they are doing a secondary investment. They are not putting money directly into the company, but they are giving money to the existing shareholder and buying their stake. Right. yes, this is dilutive, and it is basically for people who are willing to take the risk and bet on the growth of the company, right? So typically used for team expansion, growth, market expansion, uh, for scaling up, etc. So here you have a lot of companies here, whether it is angel investors, whether it is venture capitals, private equity. All of those players are basically providers of equity capital, which come into the business or replace some of the existing
Um,
investors. Yes.
Sorry to interrupt you, sir, but your presentation is getting blurred in between,
Yeah,
and the
got it.
text is not visible, so it's
Expected,
going out of
expected.
focus.
Sure. Okay, this should help. Okay, so here you have examples such as impact funds. A
It's
lot of
still
them here.
blurred.
It's
So
still blurred.
it's yes.
Okay, I will then. The font size is small. Yes, indeed, the font size is small, but it's 10. I can't change that now. What I can do is maybe. Oh, how do I do that?
One suggestion, Sai, is you could send the deck to one of us and we could then sort
Sure,
of put it up.
just give me a minute. I'm sending it to. Yeah, just give me a minute.
So we can share it from our side, sir.
Yeah, yeah, I'm sending it to you. Uh, Land. Yeah, you should have the deck. You can go ahead and present. When once I see it, I can start.
To whom have you sent it, sir? I did not got it.
It's on the joint thread pile.
Sorry, let me just check it once again.
Yeah. Yeah, I
And
can. Do you
then,
want me to present it? Or?
yeah, could you? Because Pyle is moderating today, so it'll be difficult
Yeah.
for her to monitor the chat while.
Sure. I'll just actually the thing is I was also making notes. So
So now,
if
Oh,
yeah,
that's okay. Let me
yeah,
present then because
if
we're just
that's
still
possible.
waiting to.
so
Yeah,
now,
just got
now we
it.
have got it. Yes.
Just got it. Give me just a moment. Sai, while I present, do you want to just go on talking about and reading off from your slides because you're using
Sure.
the same slide, right?
Yeah. So in the equity section, you have investors. So you have Social Alpha. You have other investors such as Upaya Social Ventures. You have a lot of them that basically invest in equity. Uh, the basic requirement would from these investors would basically be that you have some bit of traction and you have some unit economics that you can display. Unit economics basically means that every unit that you sell, whether it's a product or whether you're talking about, let's say, from a livelihood angle, if a person or if you're doing services, every transaction in your business is basically able to generate profit after deducting for the expense relating to that. So simple example that I could give you is if someone is if a farmer is growing whatever rice or paddy or whatever crop that they're growing, and the sales is let's say about 50 lakhs, providing for costs which include all of the direct costs, so any cost for inputs, any cost for fertilizers procured, etc., and also the time put in by the farmer and probably his or her family, all of that, let's say, comes to about 40 lakhs. So the farmer is still generating about 10 lakhs of gross profit. So this is at a farmer level, but for each individual unit, if you are able to show positive economics, then equity investors would be excited to evaluate further. The third source of capital is basically debt, where there is debt for uh, it could be money raised. It's basically a borrowing, so you have to pay it back at some point of time. Now, how payments will happen and what will be the rate of interest, those are determined, or those are pre-decided between the borrower and the lender. These could be banks, NBFCs, other institutions that provide. The best uses for this is typically capital expenditure such as machinery, vehicles, etc. It could also be used for inventory financing, inventory or receivables financing. We will talk about that as we go along. Here, you typically would like to match the loan tenure to asset life. What we mean by that is if the asset is something that has a life, let's say, of about 10 years. So if you're considering a capital investment where there's a machinery or a purchase of a motor vehicle, if the useful life of that asset is 10 years, then you could take a loan which basically is for slightly the longer term. Typically, you see vehicle loans at 3 years or 4 years, which are okay from that perspective. But if you what the only caveat we are trying to say here the only caveat we are trying to say here is that you don't use short-term funding to fund any kind of long-term requirements. So you don't mix something like an overdraft facility to go and buy a motor vehicle or to go and buy machinery. You use a matching loan tenure for a particular asset. For any short-term requirements, you could use credit facilities such as cash credit, overdraft. But for longer term, you use a matching loan tenure. The last one is basically blended finance, which is a combination of, let's say, debt and equity. Sorry, debt and grant, or grant and equity. Those kind of blendings that basically happen. The main advantage is that because it's a blend of let's say grant and something else or concessional capital, so the overall cost of capital comes down for the company, right? So examples of this, a very simple example that probably I can talk about because Will Grow here is on this call. So Wilgrow helped us, or we as lenders. So Wilgrow has helped companies where they have used grant as a guarantee. So there is a donor who has provided a certain amount of capital. That capital is provided to the borrower, and that is kept as a guarantee against which the borrower can raise a loan. Now, me as a lender know that there is in case there is a default by the borrower, I can always tap into the guarantee that is blocked for me, right? Now, even if the guarantee is small, I still know that I have recourse to that bit of guarantee. So I am able to reduce the interest rate that I am charging to the borrower, and hence pass on that benefit because of a blending of capital that I'm doing from some other concessional capital. So that's one example of blending of finance, but there are innumerable examples that are out today, and probably Wilgrow and WRI teams could help you access and get a network of such capital providers. right? I'll move to the next slide.
Sai, I'll just quickly come in here.
Yes.
Sorry for the interruption. Aprajita, if you could just go to menu options and bring it to full screen view, I think it might help improve the font visibility a bit. The view option
Yeah.
about this. Full screen mode. Right, thanks.
Yeah. So in this, broadly, what I'm trying to convey here is that at different points of evolution of the company, you would require very different types of capital. So at a very pre-revenue stage or maybe even early revenue, you would typically be developing the prototype or investing a lot in R&D. At that point of time, you would need, of course, you would need the entrepreneur's capital that goes into all of this, but you would also be ably supported if you receive grants or if you receive some kind of friends, family, uh, and that kind of capital, which will help you through this entire pre-revenue or early revenue stage. Broadly, that is where you're looking at. You're looking at, of course, grants. You're looking at establishing your unit economics, because that is where you're trying to understand if the customer is willing to pay and what the customer is willing to pay for what kind of product or service, right? Uh, Now, the timelines that I've given here are not sacrosanct. It doesn't mean that every business has to be in the particular duration that I've mentioned. But typically, what we use as a yardstick is that if you are not able to get out of pre-revenue, or if you're not able to complete your pre-revenue stage by, let's say, about 12 months or maybe a few months post 12 months, then it is time you actually reconsider why you're spend or the business that you're into, right? Those yardsticks, I mean, the yardsticks that you see below as duration, those are more as the outer limits for any kind of stage that you are in. Then you come to early traction, where you could use, you could of course pump in more money from the founders pool itself, or you could add on. One more trend that we are seeing is that people add on co-founders with investment, right? So a lot of companies publicize that, okay, I am already running this and I would like to invite a co-founder, of course, along with some kind of or some bit of investment, right? So you could look at angels as a capital provider. You could look at as you could look at bringing on more founders also, but of course they have their own issues that come along, but so you'll have to take a informed decision. You could also explore blended finance. You could also look at establishing a banking relationship with something like an overdraft facility or a cash credit. Now, if today, with the advent of CGTMSE, which is the central government credit guarantee scheme, you have a lot of push for startups, and without much collateral. Of course, the collateral, though it is supposed to be collateral free, there have been examples where banks still ask for, even under the CGTMSE scheme, banks still ask for guarantee, but you could explore those as an alternative for early debt. Now, what happens in that? One, of course, the business is able to establish some kind of credit and credit history. Two, the business is also able to access capital at a lower I mean, at a lower cost. Now, while I would like to break this one myth that if many of you think that equity is free capital, no, it is not, right? Of course, if you do not return equity, the shareholder does not have a way to come behind you, because it's a private limited after all. So which means that if there is a loss, then the loss is to be borne by the investor. But the issue is that the return that is expected from the investor is not single digits. It's I mean, typically it is 22, 25, 30%. That's the return that they are expecting. So if that is the case, your working capital lines or a cash credit or overdraft typically comes to you from a bank, especially at CGTMSE levels. It comes at late single digits, so 8%, 9%. You can get an overdraft facility. Uh, it could also go up to, let's say, 11 or max 12%, but it typically does not go beyond that. So 12%, I mean, I'm talking about the max. At 12%, you are still half of the return expectation or the cost that is required to be paid to an equity investor. So one of the key things that I always request you to be aware of is that equity is not a free source or it's not free money at the end of the day. Even an angel investor is expecting super high returns. So do consider lower costs of capital such as debt when you are looking at when you're looking at your funding sources. Once you move to a growth stage, that is where you could typically take equity and venture debt. Venture debt basically is debt, but which is provided by typically NBFCs or those kind of organizations where they give it to you at slightly lower rates of interest. When I say lower rates of interest, so let's say a business loan is coming to you at 16%, a venture debt fund or a venture fund a venture debt provider could be giving you at, let's say, about 13%. But for the gap or the to bridge the gap, that is from 13 to 16, they basically ask you a right that they can convert to equity at any point of time, right? So that is where they are banking on you to or for the equity value to increase, and because of that they will be able to compensate for any lower interest that they're charging you, right? So yeah, with that, typically what you would require for any of these fundraisers is that you have a proof of concept. You have at least some customers. So your first buyer is great, but at least a few buyers and some kind of traction, which is repeatable in terms of both the number of transactions as well as the number of clients. And then for any investor, you need to have a data room ready. I will not get into specifics of what the data room should have because it is different for different capital providers. But WRI or Wilgrow could share with you a very basic checklist that you need to have ready when any investor is coming in to be provided as a part of the data room. Next, Aparajita. Yeah. So I have broadly covered the concepts. Now I'm getting into applying those concepts to the specific categories of startups that we have here. So in the first category, which is sustainable agri and smart agri tech, I think there are two companies in this category, which is AgroZ, which is Millets Now, and Gramia. Typically, what you see on the left of the slide is the typical requirements that you would have through your journey. I'm not saying that this is the only requirement that you will have, but broadly, when I have studied this sector, these are the requirements that you typically have and you seek funding for, right? So one is working capital for procurement. Now, most of the time you are procuring millets or seeds or whatever cereals, whatever you're purchasing, whether it's from FPOs or individual farmers, you need working capital during the season to procure this from the farmer, and that is where you can use credit lines or basically debt to finance this, right? Second, you would need some kind of, now just purchasing millets and selling it in the market is not going to get you any value add, because that's probably what even the farmer could do. So where you add value is some kind of processing or some kind of value add that you could do to the product, whether it is make it a ready to eat meal, or whether it is like I think AgroZ makes laddus out of it, or supplies it to midday meal the kids at who avail the midday meal scheme. So things of that sort, you need some kind of a processing equipment. Here, this is basically capital expenditure, which you could again fund either via debt or even with equity. So this would help bring efficiency. This would also help fasten the entire process for you or for the company at large. Third is as you scale, you would need money to aggregate FPO produce. This is more in line with the first one, but typically in our experience, what we have seen is that once FPOs come on board, they not only ask you for market linkage, or you don't become their default market linkage partner, but you also start to help them with inputs, start to help them with advisory and those kind of things, where again there is a requirement of some kind of funding. Now, yes, you require funds at the procurement stage, but even to buy inputs in bulk and supply it to these FPOs, or make the input supply chain much easier for them, you might need capital, and that is again something that you could look to fund. Here, the other aspect that I would like to highlight is that many times it so happens that the companies that are procuring, once they win the trust, they basically dictate to the farmer what to grow and how, in what, at what timelines to grow. So that also helps you as a company make your supply chain more seamless. The last one is basically whatever kind of institutions you are selling to. Once you start to scale, you will see that many of them have a delayed, or I will not say a delayed, but basically they have a credit cycle. Now, the problem that comes with the credit cycle is that there is going to be delay in terms of their payment to you. So the minute payments get delayed, but for your payments, you require working capital to finance the next raw material purchase. So as you start to scale and have more B2B contracts or more clients on your platform, you will realize that you need to fund your receivables. So for that, again, in debt, I don't know if I mentioned, and I'm sorry if I didn't. So today, or you typically have systems such as receivables funding. What do you mean by receivables funding? So let's say you have sold to, just as an example, if it's midday meal scheme, assuming you've sold to a particular department in the government of Maharashtra, so you can take that receivable, that invoice, and once it's approved by that department of the government, you can approach any bank or NBFC and get a funding against that. What happens? So if, let's say, the government promises to pay you within 60 days, now for you to purchase the next round of millets or jaggery or whatever you are procuring, you need the money within this week. What can you do? You basically discount that invoice. So if the invoice was for 1 crore, you can get up to, let's say, around 80 lakhs as immediate funding from a bank or an NBFC, just because you present the invoice to them. What happens later? You receive the money from the government and you pay back to the bank or the financing institution with some interest, right? So in this case, what has happened? You have basically converted one of your assets, which is a current asset, a receivable, into a funding source, and leverage that to continue your production process and not stop at any point of time. So typically for the needs that I mentioned on the left, which are the four, typically you could look at working capital, which is PO or invoice-based financing, what I spoke about. Invoice-based financing is slightly easier because the sale has already happened, but there are NBFCs that also do purchase order financing, right? So it's the same process. You can walk into a bank and say that this is a purchase order that I already have from the government or from any other institution, and get a financing for that. In that case, you will basically receive money to procure raw material, to pay for your labor and those kind of things. You can have a cash credit facility or an overdraft facility. You also have warehouse receipts. Now, warehouse receipts is also something that is common. It's been there for a long, long time. Warehouse receipts is basically once you have put your products in a particular warehouse, against that receipt, you can raise funding. So if you understand the balance sheet, you have liabilities and assets. In the assets, under current assets, you have receivables, you have stock or inventory, and you have cash. Largely, these are your three broad headings. So you could use any of them. Cash, of course, is cash, so you can use cash. But against receivables, you can do invoice or PO based funding. Against stock, you can do warehouse receipts. So these are all ways you can turn assets or you can leverage your assets into forms of financing, right? For the second one, which is processing equipment, for equipment financing, you could take term loans, you could use NABARD schemes. A lot of NABARD schemes are available, and I think the next session is by Emmanuel Sir, who is from Caspian. He's been many years with NABARD, and anything to do with NABARD, I think the team here can definitely connect you with him, and that could be unlocked. You could also look at vendor financing. Now, something that typically does not immediately ring a bell for many startups is why can't the vendor themselves finance? Now, uh, when you and me go to, I mean, when we find a house in any city or any place to kind of stay, what are we ultimately doing? It's an asset that is built by somebody, and then you are breaking down the cost of the asset into smaller bits and paying rent across the time you use. The same thing you can do for a machinery, which is basically the concept of leasing. So if a person can purchase can purchase a vehicle or can purchase a machinery and lease it out to you, you are, instead of paying the entire upfront cost, you are breaking it down into smaller bits and paying in on a monthly basis or a quarterly basis, as if you have leased the asset from them, right? So that is another way of financing equipment. There are multiple leasing NBFCs, and you could definitely explore leasing as an option for equipment specifically. For any kind of market development, market expansion, you could use any other government schemes or CSR grants to expand the market. Okay. Next, Aparajita. I am.
Sai,
Are there questions or?
yeah,
Yeah.
I was just asking, like, would you like to take some questions? And if any one of you have any doubts or questions, so you can ask it maybe before we move forward.
I had a small question. I
Yes.
wanted to know about the overdraft facility offered by banks. I mean, what is the procedure? Is it easy to get it? Because we're planning to approach the bank for it. So if I get some information beforehand, it would be great.
Yeah. So overdraft facilities has not been a challenge for most corporates unless there is something really. Just a minute. Hello. Yeah. So an overdraft facility is quite simple. Many. So wherever you have your current account, you can ask them to add an overdraft, or you can ask them to convert that current account itself to a overdraft facility. If you have a deposits account or a banking account with one of the banks, you can ask. I mean, of course, they would be more than happy to extend a OD facility, because see, for banks, ultimately lending is the revenue generation mechanism. So this is quite straightforward. Also, most banks, even the tier 2 cities or tier 3 cities, will have this facility. Just in case they do not have, then you can ask them to refer to the tier 1 or their next level branch. In some cases, like some things like what I said about purchase order financing or invoice financing, many times those are not available in the specific branch that probably you're approaching. So at that time, you can ask for a referral to a higher branch or a next L-1 kind of a branch.
Okay. And is there a cap to how much overdraft can be?
That cap is basically decided by them once they review your financials. So either you give the security. So let's say you have land or machinery or whatever it is, they can give you a OD facility against that. So there are 2-3 options, right? So one, property, land, equipment, any of those could be security. Two, they could ask you for a fixed deposit. So let's say 60% of the facility should be kept as a fixed deposit with them. So that is the second kind of mechanism. The third kind of mechanism could be where basis your business, they could give you an unsecured OD facility. It depends on the bank and the institution that you are approaching.
Thank you.
Okay, somebody dropped at a chat.
Yeah, there is a question from Naga side that the challenges for early stage startups is around getting debt since they don't have strong P&L. So what should be path apart from equity and grants?
Yeah. So this is a major, I will not say, yes, I agree to your question, which is getting a debt is slightly difficult. But I would like to caveat that getting a unsecured loan is difficult, but getting a secured loan is not so difficult, right? If you're doing a motor vehicle purchase, when you and me go buy a bike or a four-wheeler, the asset itself is the security, right? Now, yes, they would ask us for our income slips or pay slips and things of that sort, but that is not. They are not taking your income as security, right? You continue to get your income in your bank account as salary. Nobody's putting a stop to that. The hypothecation is on the asset that you're financing. So asset financing should not be a problem. If a bank is not willing to do it, you can approach an NBFC. This misconception leads into something else, which is many startups feel that if a bank is charging 12%, 13%, even 16%, that is costly. But if you're going to finance, if you're going to finance growth by equity's minimum expectation is 20%. So you have a clear 4% arbitrage even at 16% between equity and debt, right? So and also please understand that of course you might be saying that I work for a debt fund, so I'm purely biased towards debt. Yes, you can hold me accountable and responsible for that statement. But the point is, the minute you take equity, you have lost value on day one, right? If you own 100% of the business and you allow an equity investor to come in, even giving them 10% of your equity in the company, you have lost the 10%. If there is value to be generated from your business, 10% of that value is never going to accrue to you, but it's going to accrue to that investor. So you are paying 20%. It is not said on paper 20%, but that is the expectation that the equity investor has. So you're paying 20%, and that value you're generating not just for yourself, you're generating for yourself as well as that equity investor. So I would rather suggest that you go down the path of debt. Sorry, Sai Krishna. I don't know which bank you've dealt with, but okay, I'm reading directly from the chat. So his question is that the timelines for debt is way slower. You can ask somebody who has raised equity. No equity funding has come within 6 months. Okay. And they have due diligence, they have documentation, everything goes beyond 6 months. For debt, turnaround times are less than 2 months. So I am sorry on that one point, I will defer. The third question was options are limited, right, for debt. It depends on what you're seeking funding for, whether it is machinery whether it is a general unrestricted kind of capital. You have OD, cash credit, those kind of things. You have machinery financing, you have asset financing, you have leasing, which is a kind of debt ultimately. You have inventory financing, which is against your inventory. You have receivables financing, which is against your PO or invoices. So I don't know what else, what other kind of financing you're looking for, but there does the Indian market have loans against equipments? Yes, it does. If it's agri-related equipment, yes, there is financing from people like NABARD. There is also financing from leasing institutions such as Shriram Transport and Shriram Finance. You have all of them providing leasing or equipment financing. Okay. Yes.
Sai, Prajwal also, and before we move to, yeah, Prajwal, you can ask your question. Prajwal is from Oscillo Machines. So,
Okay.
yeah, Prajwal, you can ask your
Yes,
question.
so we had a lots of jumping between the banks when we want to avail the mudra loan or the without a collateral part. So, so my experience with that is that personal guarantee from directors is required to avail the OD facility from the mudra.
See, that is what I said, that Mudra, CGT, MSE, while it is a clear directive from the central government that they should not be taking
Yes,
any
yeah.
security. Uh, at times, what happens is they do ask for some security, and that depends purely on the bank that you are interacting with. There are of course banks that have not taken in our experience, and there are
Like
banks that
in
have taken
it,
also.
it's not in terms of collateral like collateral as a property or a land or an equipment. So the two they have done, like one is they have inventory based uh, debt finance, and they also took the personal guarantee of the director, which is also reflecting on my personal bank account as well. So I asked the bank, why is it like that? So it's a normal procedure, because since you are
Yeah, so
director,
that is
also need to do that. Another thing is
yes.
we are in
Hmm.
rented this thing facility. We are renting the facility for the manufacturing. So the owner is not comfortable to do NOC because he had a past experiences which is not good. So how can we tackle that? Maybe in next year we get a revision of our OD. So NOC might be required, which may go that. So is that how we can tackle that situation? Because the owner is not that uh, like willing to do any NOC to involve him as
uh,
well.
Sure. Okay. One, sorry, maybe I can take this offline, but I am not
Okay,
understanding why the owner
sure.
is involved. But on the personal
Because a
guarantee piece that you,
bank asking apart from the agreement, owner's NOC is required because it's based on inventory and other things.
no, inventory, they need to come and check inventory, no, not the place that you are in.
But they require NOC, even though in agreement we
Yeah.
clearly mentioned it's a property of an Oscillo, whatever we
Yeah.
manufacture and other
So,
things.
sir, I will
Sure,
connect with
sir.
you again. But
Another
on
one
the
final
personal
doubt.
guarantee part,
Yeah. Yeah,
personal
sure.
guarantee part, again, it is up to the discretion of the bank or the
Mhm.
NBFC that you're dealing with. Some of them do take, some of them are happy with whatever security you have given.
We also have a special scenario where one of our customer really wanted to uh, have some interest in the R&D part of it. So he may
Mm,
not be want the equity side. So he might want to loan us like an OD style. Like
mm,
he might invest like suppose 5 lakhs, then we have to give them back a certain interest. Not
mm.
immediately, but periodically. But we don't want to be involved as an equity partner or something. So when I discussed with my CS as well, so there is no provision so that we can take a public money. But how can we tackle this situation because he's already a customer as well?
Yeah. So there are two ways here, specifically to this case. Uh, Sorry,
Huh.
I know it's
Pra-
Oscillo Machines, but I don't know your name, sir.
Prajwal.
Prajwal. Okay. You can lower your hand. Thank you.
Yeah.
So basically, there are two ways to look at this. One, if they are willing to if they are willing to, if they are already a customer, they can give it to you as a customer advance.
Or GST implications will be
No,
difficult
customer
while
advance.
paying back.
No, you. Already.
I'm so sorry. I will come in here. Very sorry to interrupt. But I think because we have a time check right now,
Sure.
let's take the remain. I would encourage you to put the question on the chat as well, Prajwal, and let's take it up towards the end of the session.
Oh,
Before we move, I think Arun also has asked a question. Sai, Arun is from our team only, from WRI team. He's the program director
Right.
from the climate finance team. So, Arun, do you want to ask your question and unmute and ask the question?
I think Sai stepped away from his system.
No,
Oh,
I'm here. I'm here. You can.
so Sai is
Okay.
basically asking, like, does the Indian market have loans against equipment, like loan against property? So,
Yes, you do have loan against property, but typically you will get that more like a personal loan. You will, or you can give it as a security for ODs,
okay.
right? So, but typically they will not. You will not be able to get it otherwise. As in, you cannot. So if you are purchasing, so if you are getting a loan for unrestricted use, which an OD will fulfill. For that, you can give property as a security. But for other things, right? So suppose you're purchasing a specific kind of equipment, or you want loan against your loan for your raw material purchase or things of that sort. For that, I mean, you are basically giving away a very a high value asset for something that you could alternatively get a loan for.
Okay, so maybe rest of the questions we can take at the end of the session since we have time constraints also. And you all please keep dropping the questions in chat.
Sure. Okay. So for soil restoration, I think that's the other category that of cohort companies here. Typically here, I think companies like Arogyam, Arkashine, yes, Prajwal Osil also comes here. So in this, you typically have R&D prototyping, which you could finance from grants, government R&D schemes, any innovation prize monies that you could receive. The second could be at institutional sales. I mean, once you establish a particular product market fit, you could look to institutionalize sales and grow further. So for that, if you're looking at manufacturing, you could look at term loans, again NABARD schemes, which are very useful in this aspect. Most of the factors are similar to what I spoke about in the previous one, so I will not repeat. But in case there is a specific question, happy to answer that. And the third is to scale up manufacturing, because most of these, at least most of the companies I mean, the most of the websites that I went through, all of you have all of you have some kind of hardware or some kind of equipment that you are ultimately manufacturing, whether it is contract manufacturing or in-house manufacturing, doesn't really matter. But when you have to scale manufacturing, to a certain capacity, you will typically need when you will typically need loans that you can raise, or you have somebody who has I mean, you can bring in an equity investor uh, who has an interest in this business. Now, one other thing, and this is not just for soil restoration, but even for the other sectors that we spoke about. If you are able to bring in, or if you're able to elicit interest from a strategic investor, that's way more beneficial rather than getting money just from any other equity player. So I would maybe, while you are anyway researching for equity investments, maybe also look at listed players in that segment, or it doesn't have to be specifically in your segment or in your area of work. It could be slightly tangential also. So if somebody is doing stuff in agriculture, you could also look at, let's say, fertilizer companies or Jain irrigation kind of things. So that is one side of the story. You could also look at people who are processing, processing agri and basically in the food processing space. So because they understand the value chain and they will be able to give you inputs both on the business as well as they will be able to fund you to a large extent. I'm not saying go and ask those companies. I am only saying that try and see if you can find those companies and if their promoters are investing. Most of these companies have promoters who have interest, at least off late, to invest in startups. Now ultimately, if it is costing them, let's say whatever, a crore, 2 crores, or even lesser, they are happy to do away with that in the hope that they can get they can get some good returns sometime in the future. But for you, it one of course gives you immediate funding, but it also gives you strategic advice from person in the industry to kind of navigate the ways of the industry, right? Um okay, I will then move to the next piece, which is I think circular economy. Aparajita, next, please. Yeah, thanks. Okay. See, in the circular economy, I think there were two companies that basically were kind of shortlisted or put here, which is Navaka and Krishi. In both cases, I think uh, while we are, I mean, typically we would associate circular economy more with services business, but I do see you do have a product angle to it also, which is biochar or that kind of thing. So in all of this, where there is, whether it is complex technology or very simple technology, whether it is your that conical thing to make biochar, or whether it is the science to make it on the ground, whatever it is, you will have requirements of funds for R&D and prototyping. You will also have now, because for especially when you are trying to avail carbon credits in I think one of your models or both your models, there is a mention of this. So there will be funding requirements for digitally monitoring, reporting, and verification of this. Now, certifications do not come cheap. I mean, even if you are able to get it at a discount, even the discounted price is not really cheap, and you will have to get it for quite a lot of users because you are engaging with hundreds and thousands of farmers. So if it's a digital platform also, the monitoring reporting will require some good amount of funding. So you could explore, you could largely explore equity money for that, because this is something that probably debt or grant will not suffice. Debt will not, I mean, because it is unpredictable, debt will not be the most efficient use of resources. So you could rather look at funding this from equity. The third is for carbon verification, which is basically the validation of your methodology, whether you follow Vera or you follow gold standard or whichever other well-known standards you are tying up with or benchmarking against. For all of that, again, there is some bit of funding need, and the financing options for that could be either equity if you're able to garner that kind of equity funding, or you could also look at financing from carbon players through prepayments and offtakes. I think a lot of at least a lot of what at least I've seen is people in the agroforestry space have done this prepayment and offtake thing very well. There could also be carbon financiers who are willing to do this. In India, it's a very small and tight market, but there are of course more players across the globe who can help you navigate this funding requirement. Yeah. The next, yeah. Okay. Again, similar for the non-timber forest produce. I think here, again, the requirements are pretty straightforward. One is, what do you do with so if it is fruits, or any perishables that come as a harvest from the forest. So we had funded an organization sometime back, again in the Chhattisgarh region, which was dealing with black jamun and those kind of forest produce. So in all of that, I think there is fund requirement, one, to extend the shelf life. Now, whether you are doing dehydration, solar dehydration, or you're doing electric dehydration, or you're doing, you're doing some kind of value add processing, cold storage. For all of this, there is an investment in terms of processing capability or capacity that you will require funding for. In terms of traceability, again, you will, to ensure that this is, the source is right, and this is, if there is also an overlap of GI tagging here, then for all of that, I think for traceability, again, very similar to certifications, you will need some kind of benchmarking, and for that benchmarking, you will need funding. The last one, of course, is your PES readiness for the ecosystem services. I think for all of this, these could all be different requirements of fund in the near term or even in the medium term. This financing need can be met by taking either loans or schemes available from the government for setting up infrastructure, for working capital, any kind of working capital. The best source of funding would be debt in any of its forms that we discussed previously. uh, for any kind of establishment of processes, any kind of traceability and protocol and systems establishment, I think it definitely should be funded by grants or incubator or accelerator kind of uh, grant money or CSR money. And for the ecosystem services payments, I think that could come either from CSRs or from grants. Again, it could also be tied to because all of these are still unproven or largely nascent in Indian markets. So you would still need funding to come from sources such as grants or CSR. Once they are more mainstream or more acceptable in the market, that's where probably equity or debt would be readily investing in those areas. Okay, I'll pause for questions because I've spoken about all the four categories that probably the cohort is categorized in. If there are specific questions in this, happy to answer. Else, I think we can move to the next section.
We had some questions in the chat box. So, like earlier, Jayanji, do you want to unmute and ask the question? So, he's basically asking that restoration-linked business models need longer duration to generate returns. In such scenario, what would be interested in providing? Who would be interested in providing debt or loan?
Yeah. So if you look at this, sir, that is why. So if you go back to Aparajita, if you go back one slide up in the or the two slides up in soil restoration, you actually look at one. You can actually you can look at uh, if there is a carbon angle to all of this, you could also look at carbon finance. But if you are specifically looking at a debt or a loan kind of thing here, that might be slightly difficult. What you could look at is if there are customers who are willing to pay or who are willing to provide some kind of an advance, then that is not a formal debt or a loan structure, but it effectively acts as a loan for you. And that could be that could be for the slightly longer term on a rotating basis.
So Janji, we hope that it answers your question. Next, we have a question from Dr. Manisha from the Open Field. She's asking like if the PO includes community capacity building and ecosystem work that does not generate immediate cash returns, how do investors or lenders usually view that part of the model?
Yeah. So typically, see, vendor, any capital provider is going to look at specifically the business and what that business can generate. Now, if you are also including community capacity building or any kind of ecosystem development as part of your project, right, that will not be funded by a debt or an equity player. That would come to you as part of technical assistance that you either raise or a TA provider is helping you with, right? So just as an example, right? So when FPOs, so when FPO started off, about 10 years back, right? Or the concept of FPO started 8 to 10 years back. The government came and said that anybody can help start an FPO. Right now, to set up the FPO, what did the government say? That the first 3 years, whatever OPEX is there, we will pay for that, right? I mean, half of that, or basically 50% or 60% of that expense, the government will bear, and the rest the FPO itself has to bear. Now, when FPOs, if the FPO were to raise money in the market, right? For the OPEX, no equity investor or debt investor would anyway give funding. That would have to come from the NGO or from the government side. But for the work that the FPO is actually doing, which is, let's say, providing market linkage or providing inputs or doing some value add or processing, for that they could raise funding from, let's say, an equity or a debt investor. I hope I answered that.
Manisha, do you want to add
Yes,
or?
yes. No, I got. Thank you. Thank you so much.
Okay, so Abhishek, do you want to ask the question? You can unmute and ask if you want.
I thought that was a comment rather than a question. Abhishek, go ahead.
Do you want to like ask something or Abhishek?
Yeah. Uh, yeah. So basically, we were looking for some schemes of for funding manufacturing through NABARD. Like, can we get some ideas like what kind of resources are needed to avail them?
Sir, I will. I can help you, but there's an expert in the next session who has worked with NABARD for like years, so he knows NABARD in and out. If it's okay, you can wait for that long. I don't know when Emmanuel sir's session is, but that session will be way more insightful than whatever answer I give you right now. Right, and if it is urgent, I think WRI or Wilgrow can connect you directly with Emmanuel sir.
If there is no other question, we can maybe proceed further.
Yeah, you can go to the next set, which is yeah. So three quick case studies in the Indian market context. All of them have been some way related to the sectors that are in the cohort. It's Equilibrium. Then there is the MP State Millet Mission, which is again connected to sustainable agriculture, the first category that we spoke about. This one is in the circular economy, the biochar, and that segment. And the last one that we have is Farmers for Forests. I think many of you know them, and how they were able to raise money from Zerodha, and that is in the agroforestry set of things. So in Equilibrium, basically these guys were people who Equilibrium is basically the carbon removal developer. They have projects which they set up, whether through agroforestry, mangroves, biochar, all of this, but all of them move towards carbon removal from the atmosphere, right? So broad statistics, I think they've developed about 120,000 hectares, dealing with 150,000 farmers, and all of that. So if you look at how their capital journey has been, in 2021, they did a lot of proof of concepts. During that time, A lot of money was raised via grants, similar to probably the phases that many of you are in right now. So whether it was innovation prizes, CSRs, grant money that came in, a lot of that went into the development of a proof of concept, and also the methodology, carbon methodology validation. In 25, they raised money via blended finance instrument. Here, a lot of philanthropic capital came along with carbon financiers, and with that, they were able to scale to 8 projects. So that was a 2 million thing that came in via blended finance. There is a whole article or news that is there on the website, as well as as well as the internet. You can definitely read about what kind of instruments that came in. But basically, there was a lot of philanthropic interest that helped them catapult to those 8 projects. And again, so this was, I think, in Feb or March of 2025, and in September or October of 25, they raised their first equity funding, because they had shown the traction from 21 to 25. That traction and business viability was proven. And that is when in late 25, they raised their seed round of 3 million from Kalari Peak Ventures and Avana, right? So, uh, key takeaways here, I think, starting with patient capital, because this is something that you can experiment with. There is no pressure to return that capital. It's for you to kind of use at your discretion, and build something very strong as the foundation. Second, I think a lot of trust came from the ecosystem that they were dealing with, which is the FPOs and local bodies that they were interacting with on a regular basis, and that helped them to operationally scale up the entire projects that they were doing. And the third, of course, is if there is a tech angle to all of your work, it helps build credibility, especially when you are trying to capture things like carbon data, whether it is carbon removal, carbon sequestration, any of all of that. If there is a technology angle, it helps save effort as well as build credibility. And even the investor is quite excited when something on these lines is a core part of the business. Okay, the next case study. Yeah. So this case study I specifically picked up for I think the first two, which is Millets Now and Gramya. So if you so one of the things that you can also look at is, if you have government, and I think Agrozi, which is Millets Now, already has this, but if you have government as one of your key customers, I think that is it's a very big breakthrough. Of course, it takes time. It takes a lot. I mean, it's one of the longest sales cycle that probably you can ever find. But if that is something that you're able to crack, then that becomes a very interesting thing for future fundraisers. So the MP State Millet Mission, I think this is basically in the state of Madhya Pradesh. The budget that is sanctioned is about 23 crores, and in which the government basically procures millets for their midday meal schemes and other schemes of the government. There's also it also establishes a support price for that particular product, because there is an MSP that is decided, and that basically helps you also set a price in the overall market. And because the government is already a buyer, any excess or any additional produce that you have, you could also be selling it to other B2B clients. And you could also look at one, you could continue looking at the B2B channel, but you could also look at value adds or food processing and build a retail brand, because what will happen in the kind of medium to long run is that the government business will act as a annuity business. They will continue to give you a certain set of profits year on year, and those profits can basically be used to invest into growing the retail business or growing the processing business. It can be a white label product, it can be a brand building product, depends on what you want to do. But that is something that definitely can be explored, especially when you have a client such as the government backing you, right? So if there is an alignment with state policy or any of the state schemes, so for all of you, I think a good research into what all different kind of schemes are there by the government. This will also open up doors for funding sources in most probability. The other way of looking at it also is, don't just look at startup funding for the company directly. It could also be funding from the government to, let's say, farmers who are growing X kind of whether it's millets or whether it is any other product. The government might not be directly giving you the money, but if they are helping your farmers with loan waivers or with any other thing, then probably some bit of your work or your process gets eased, and you can take the business forward with more confidence. Um, because there is government at the other end, that then you have to focus on standardizing your quality, and somebody like a government will definitely help in moving towards that. And any MSP that the government sets is basically a safety net for your farmer. So even if the farmer is not selling to you, or even if the farmer is selling to you, there is a clear price, there is a clear base price that is established by the government. So that should not be hurting the farmers that you procure from, or when they sell it in the open market. Okay, the last case study, I think the company or Farmers for Forests has been in association with a lot of incubators, and Divya just mentioned that they were also part of LA. They recently got their funding from Zerodha, which is basically 100 crore commitment for restoration and payment for ecosystem services. So when they started off, I think they piloted this, they explored a lot of models, and very similar to what somebody asked, which is, if the results are delayed, if I'm doing something today, and I think somebody mentioned about restoration projects where the return is expected later. So this is a clear case, where you grow a tree today, and basically this is the agroforestry model. So the tree is grown today, but basically the carbon credit or any of the result from planting that tree is basically 5, 6, 10 years from now, which is basically generation of or absorption of carbon and production of oxygen, right? So in those cases, a very clear thing is to understand what your revenue stream is going to be, and scout for like-minded funders. Now these could be carbon financiers, or it could be other companies such as Zerodha or other such like-minded organizations. But basically, uh, if you are able to build a long-term commitment, that commitment is not just from the company, but also from your ecosystem. So the farmers that you're dealing with, the members of the society that you are dealing with, all of them have to be committed equally like you. Then the project is bound to move forward. So a long-term commitment definitely matters. The trust and building that trust via technology. So if you have satellite imagery, or if you have drones, etc., which are able to provide credibility in terms of whether it's agroforestry or whether it is in terms of other techniques that you're using. If there is technology to back that, and if you're able to also have different revenue streams, that would help you be a better chance of funding rather than just one or two revenue streams. So all the three case studies that I took were people where they've raised one different source of capital, which is across grants, debt, philanthropic capital, blended finance, all of that. Two, it's also been across the various categories. Of course, I've not covered all the categories that the cohort has, but I've tried to keep it as diverse as I could, and accordingly, put it here. Okay. I'll before that, I'll just pause. Any other questions? And then we can move forward.
Jayanji, you can unmute and ask whatever query you have.
So yeah, so I was going through the equilibrium model, and if you look at the numbers, I think it is talking about 120,000 hectares and 5 million funding. So it comes to 1,600 rupees an acre. We don't understand when you talk about business, you have a unit economics. I don't understand whether the farmers are getting 1,619 rupees per acre through carbon removal, or it includes management cost. How much money farmers are going to get? Because I'm just going by $5 million at 95 rupees a dollar. Even then it is coming to 1,619 rupees, which will be definitely, I don't think, I need to understand how this is working. Secondly, and you might not have the answer, but this is something that we need to really understand, that what it takes eventually back to 1 acre, benefit per acre. And secondly, when we look at the scale, all the startups who are part of this cohort, I think with this scale, they shouldn't get overwhelmed. When are we going to get there? Is scale the only criteria to to get investment? Because a lot of people might just give up, and we will not be in our own life, achieve 100,000 hectares or something. So this is something that we need to also clarify, that with everything, do we need to have a scale of that sort? For example, even the state government of Madhya Pradesh, talking about something in crores. So when people are starting, what vision they should have? They should have only one vision, that I need to cover 4 states and these many farmers. Is this the way we look at actually creating outcomes for conservation restoration?
Sure. So Jayanji, on the first one, sorry, I don't have an answer. You can, this was more for more because I wanted to show how they have used different funding sources to grow through their journey. That was the only thing. The specific numbers in terms of hectares and return to the farmer, that I am not really sure. Second, to the question on scale, I think see, there are two angles to this, right? So at that scale, yes, you need that kind of funding, but it doesn't mean that everybody has to. One is, of course, the ambition to grow to that kind of scale. If there is a potential in the business, of course, maybe even 120,000 hectares is small, right? But that doesn't mean that. And if you look at it, they started in 21. Farmers for Forest started in 2020 in 2018. They have some thousands of acres that they are covering. So my only point here is that one part of it is that, yes, if there is enough if there is enough force in the business, or the justification in the business, it can of course scale. The second is that at different scale of business, there is a different funding requirement. So when they initially started off in both equilibrium and F4F case, in both the cases, the initial thing was grants and donor kind of money. Only when they scaled to a certain level was when commercial capital came in, the likes of Zerodha or VC funding. So I hope that clarifies that it is not that at the initial stage itself you require millions of funding.
There are some other queries also, but maybe we can wait and take them at the end of the session since we have less time.
Okay, sure. Yeah, we can move to the next section, Aparajita. Yeah. Okay. So broadly, so this is something that you can do in the next 5 minutes. And of course, if it was I initially thought this was a offline thing. So I had kept the pairing, but you can share it with the WRI / will grow team for their understanding also. And if they have any feedback, they can share it with you. But what I would like all of you to kind of make notes of. You can take a Excel, you can take a Word document and try and do this. So there are 6 parameters that I've put here, and each of these parameters, there are 4 circles or basically a score of 0, 1, 2, and 3. So I will explain each of the factors and you can rate yourself on a scale of 0 to 3 where you think you kind of stand today. So one is on the financials. So when I say financials, it includes how much cash runway you have. Now, a easy formula to calculate cash runway is how much ever is your cash balance in the bank or in hand today, divided by your monthly average expenses. When I say expenses, it includes expenses for purchases of raw material, labor, etc., plus any kind of corporate overheads, electricity, manpower, salaries, any of all of that. So on an average, what has been the monthly expense and what is the current cash balance? So cash divided by monthly expense should give you your monthly or should give you your runway, right? Then the second is the unit economics. And the third, of course, is audited financials. Audited financials is something that I think everybody has, but unit economics is something probably many of you might want to review the current stage. Uh, I will not be covering unit economics in this session, but if you are not aware or if you still have questions, then maybe will grow team could clarify or WRI could clarify later. So these broadly these 3 things. One, because cash is king. So if you do have cash and you are comfortable, then I think the score is quite high. Unit economics for audited financials, I think it's still doable. For unit economics, I think you might need some bit of homework to try and understand. So overall, on all these 3, a score from 0 to 3 could be something that you could assign for yourself. Right. The second is basically how deep or how penetrated is your market. What is the kind of customer traction? So if you are a B2B, if you are in the B2B business, do you have signed purchase orders? Do you have commitments, soft or hard, from your clients? What has been the churn or retention of your customers? Has it been high? Has it been low? Or you've not, probably you've not seen enough of the customer life cycle. Then probably you can keep this on hold. What has been the lifetime value of the customer, and at what cost? So if you have gotten a retail customer, whether it's a farmer or whether you're selling to anybody else, uh, how many times have they come back, purchased from you, and what is the cost that you've incurred to acquire that customer. So again, CAC by LTV or LTV by CAC, I think this is again something that is quite standard. But if you do not know, or if you are unsure of what this is, then probably the WRI or Will Grow team can help you later. Right. So broadly, the market segment captures what is your customer traction, what has been the revenue growth, and has there been growth, and basically has there been market validation for your product. So basically, a product market fit has been established or not. So you could score yourself on that. The next is how well or how seamless your operations have been. Do you have standard operating procedures? Do you do any kind of quality analysis or quality checks? Do you have your inventory systems in place? Have there been rejects from customers because of faulty inventory or faulty stock? So all of those is what I have as part of operations, including do you have long-term supplier relationships, or most of your suppliers are asking for a a sample, and then post that they are not kind of ready to continue business with you, or they are super excited to continue business with you. So depending on that, please rate yourself from 0 to 3. The fourth is basically in terms of impact. Are you measuring your impact? Do you have a baseline? Do you have a midline? Probably you don't have an end line because you're still working towards it, but do you have indicators? Are you collecting data on a regular basis? Whether it is monthly or quarterly. It definitely should not be annual, because annual is too long a gap. So on the impact, are you able to have some kind of impact measurement? And also, has it been verified by any third party? If it's been verified, then I think definitely it's kind of towards complete. While if it is still something that you have been kind of reporting or collecting, then probably it's in the early or partial stages, which is 1 or 2, right? Then on governance, how does your cap table look? How does your board look? And have there been delays in compliances? Now, compliance is slightly broad. Uh, it starts all the way from, do your workers get their ESI, PF if they're eligible? Do you have a gratuity policy? Do you have a posh policy in place? Do you have minimum wages in place? Are you a responsible tax paying citizen, or is the company a tax paying entity? Do you have GST in all the locations that you're operating from? So all of that is broadly part of compliance. Of course, there are a lot more. So on the governance aspects, how would you rate yourself? And on your partnerships, this is more on the client side. We spoke about supply, and now this is clients, which is basically your engagement with FPOs, SHGs, whoever is your client, or if they are institutional buyers or retail customers, what is your partnership with them? Is there churn? Are there purchase orders and MOUs signed with all of them? I think that is broadly on the partnership side. So I'll take a pause. You can, of course, I hope you could understand and you could score yourself as I went along. But if you have any questions, I can clarify.
So I just wanted to mention one thing, that we have like exceeded the time limit a bit, so I think we need to take care of that as well.
Okay. Fine, then I'll leave this with you to collect and verify. If there is something that I need to add, I can come in. Okay. The last I think 1 or 2 slides are left. Next.
Sorry, can I just quickly ask one question?
Yes.
Sai, so when people sort of rate themselves the cohort members, right? So the scoring out of 18, maybe if you can also sort of guide us, what does it mean, right? So, what
Yeah.
does it
So
score?
there
10 or
there are
15?
six. No, there are 6 here, and the highest score that you can get is 3 for each.
Ah,
So that's why it's 18.
right.
So each parameter is rated 0, 1, 2, 3. And sorry, it's not the regular 1 to 5 kind of a scale. But basically, to have a scale for missing, So there could be some aspects which are totally missing. Like let's say governance is zero for somebody. Like it's just one person running the entire show, and it's more like a sole proprietorship or something of that sort. So that's the reason why that is it's in this way.
No, that's fine. Actually, my question was overall on the total score, right? So can we read the total score like if it is 15 and above, 15 out of 18, what does it mean in terms of your
Yeah.
readiness?
Yeah. So the higher the so there's no benchmark per se, but basically higher the score, the easier for you to avail funding. That's the way to read it. Because if you are when any VC comes in, of course each investor might focus on certain aspects only, right? So for debt, they might focus more on financials and let's say on partnerships, but they might not focus so much on impact. Let's say a bank really doesn't care how much carbon you are saving for the environment, etc. Those kind of things, right? Or they might not even care about what is your board, and do you meet 4 times a year? Do you meet once a year? What is it? But for an equity investor, a lot of these are important. Or even if they choose to invest without these, they will ensure that once they invest, they have all of these in place.
Okay. All right. Thank you.
Yeah, Aparajita next. Okay. Initially, I think we spoke about data room. I will leave this slide with all of you, but broadly, this is what constitutes the basic data room, and this probably is something that even will grow and WRI can help you with. But again, it is tying back to the factors that we spoke about just now, the 6 different factors. So corporate governance, in terms of corporate documents and all of that, financials and financial records, legal contracts, impact, compliance, and operations. So most of this, if you have it in one place in let's say a single drive and you keep updating, that makes your fundraising process a lot more easy when it comes to that stage. Otherwise, scrambling for each of these documents at that point of time, could kind of even risk losing funds that probably could have come to you from the investor. Next. Yeah, okay. This was, I think, probably the last slide. So how you could go about, and this is more for you to think about and come back to this, time and again, depending on what you really want to seek funding for. So if it is something to do with customer demand, POs, offtakes, etc., there is a way to go about. If the funding is for assets or for market expansion, there is a specific way to go about. If it's for carbon pipeline, and if the carbon pipeline is validated, then there is a certain way to go about. So broadly for these 3, depending on all of the companies that are there in the cohort, I thought these were the critical 3 parameters that were required. And for each of these, I think I've given, if you're looking at demand is certain. If your demand is certain, then you can definitely avail working capital loan or invoices. Otherwise, depend on grants. That's the easiest way to meet working capital requirements. But of course, grant is not the ideal way. So better move to working capital or invoice based financing, and basically uh, improve your product. If it is a requirement of assets, then you can avail a term loan. That's the cheapest that you can try. If you don't have, if it's not asset specific, then you could look at equity or grant. And for the last one, if your carbon pipeline is already validated and established, then look at prepayments as an option. Again, this is the cheapest. Otherwise, if you've not and you're trying to set up your carbon pipeline, then grants would be the way forward. Yeah, I think with that, I end. This is a sheet for you to take back. This will be with you, and this is for you to think about what is it that you really need it for? What is the amount? How do you think you will source it? So all of what you learned or what we discussed in the last 1.5 hours, you will kind of be able to summarize in this one sheet, saying what is it that you need the money for, how much is the money, what is the milestone if you're looking at, and then what is the data or data room documents that you have in place. And with that, also what is the risk and mitigation that you will have if that does not go through. If let's say you don't get funding, then what is your option B, option C? uh, Take time, fill this out, keep this with you. You can keep coming back as and when you think there is a need, and when you fill this, it'll give you more clarity. Yeah, that's it.
Thanks. Just before we open the floor for Q&A, so I wanted to check in with you that we'll be sharing the scoring exercise as well as the financial planning exercise that you've shared with the cohort members. We'll be able to just compile all the responses that we're getting and share with you. In case you have any feedback, you can share for the cohort members.
Done.
Yeah,
I can do
thank
that.
you.
Thanks.
So that way, just making best utilization of time as well, because we need about 15 minutes for office hours. Yeah, I think I would just request everyone to utilize maybe 5 more minutes for Q&A before we move on to the office hours. Feel free to raise your hands, unmute yourself, and jump in. Dr. Amrita, I can read your question here on sharing request for sharing a structured checklist or framework of the subcategories that we should typically evaluate while assessing. So it's the due diligence checklist that is there. This would not exactly come under the scope of the current session that is there, Dr. Amrita. Maybe during the one-on-one support that is there, when we progress to the next stage, this could come in. But if anyone else wants to come in on clarifying this question, please do. Yeah. Okay. Any other questions? Prajwal, did you have some questions that needed to be closed? Please feel free to utilize the next 3 to 4 minutes for that.
Yeah, like we were discussing about that. We can take it offline because it has many conflicts. Apart from that, that's the only thing. Personal, even though they like personal guarantee, I objected, but personal guarantee, I was not aware of it. But later, when it reflected to my account, then I got surplus. So,
Okay. Yeah, like you
but
said, yeah,
yeah,
maybe that would require a little bit of customized support that you could get later
yes,
onwards.
yeah.
Okay. So if there are
But
no, oh, Jayanji.
No, I have one question, and this probably will everyone from the cohort would be interested in. Learning is whether this belongs to this session or not. But I think how do when we have talked about a lot of times about unit economics. So each of the cohort member, if we are given the particular spreadsheet that this is how these are the factors that you need to consider while coming to the, because when we get in initial period, when we get the grants to implement your project, you are not much bothered about coming to that. But when it comes to an investor, he will ask this question, and then you are running for every other parameter that you are not estimated or included in your unit economics. So I think that would be really useful if any format can be given to us, so that we understand that where we are actually what is affecting our profit margin or what we have not considered,
Maybe
Jayanji, I can, yeah, I
sorry,
will
I'll
leave it
go
to the
after.
WRI team and and we'll grow a team to decide how they want to do this.
So Jayanji, thanks, Sai. Jayanji, this is in the plan. So this is coming to you, right? So we have this is part of one of the subsequent sessions where we'll try and share what are the kind of the usual sort of metrics, financial metrics, business related metrics, profitability metrics that investors look for. And of course, I mean, these are going to be common to restoration linked kind of businesses, right? So we will come to that, and then there'll be a little more one-to-one discussion in the subsequent stages for those who advance to the next stage.
Thank you.
Okay, so if we have no other questions, I think we can just proceed to thanking Sai for his time. Thank you so much, Sai. I hope you, yeah.
Yeah, I just wanted to take a screenshot. So can you please
Oh,
turn
yes,
the
we have
camera?
a
Yes.
picture for the post.
Yeah. And yeah, I think Nagasai also had some comments. So can we address that, or this carbon credit can play around? Okay.
Let's take them over email now because we do need some time for office hours and announcements. Would request everyone to please turn on their videos. There's going to be a social
Yeah.
media post with key insights as we usually do after our capacity building sessions.
And while
Yes.
Mike does that, maybe just a quick another reflection on this. And Sai, correct me if I'm wrong. The financial readiness, sort of the exercise that you've shared, I think a lot of the workings are also going to be useful for future calculations, right? That businesses need to do to present to investors, because it doesn't have the metrics exactly, but I think a lot of the information is going to be useful to feed into calculating those metrics whenever
Right.
businesses learn about those, right?
Yeah. So, like what I think Jayanji asked just now, which is on unit economics. So, unit economics itself could be like a different calculation session, all of that. But this is just benchmarks saying, okay, if your unit economics is ready, then probably you are at state. I mean, you could rate yourself 2 or 3, and so a culmination of all of this is basically what would increase your chance of getting a funding.
Yeah. Right. Thank you.
So there's done. I've taken the screenshot.
Okay. Great. So thank you so much. If there is anything, I think the WRI team will get back if there is something on over email. But thank you all for this opportunity, and hope we learned something today.
We definitely did. Thank you so much, Sai. It was a wonderful and engaging session and very relevant, like I said before as well. And the cohort was very excited for this session, and we hope, the expectations have been met. So we'll let you know on the feedback as well. Thank you so much,
Sure.
Sai.
Thank
Thank
you.
you.